Hello, and welcome to the Evergreen 2024 Outlook and Positioning uh, discussion. Today, Derek Varner and I are going to review what happened in 2023, setting up for end of year, and then also have a discussion about where we're headed in 2024. For many of you, you may be meeting Derek Varner for the first time, although I've been working with him for more than a decade, and he sat across the table for many clients. So let's just take a quick moment, Derek, for you to introduce yourself, please.
Thanks, Andy. Yeah, it's nice to see everyone virtually. My name is Derek Varner. I'm a member of the investment team and the Evergreen Investment Committee. I've been focused on investment management for my entire career, which is about approaching 2 decades, believe it or not. And previously, I was the Associate Director of Investments for Bucknell University in North Central Pennsylvania. And Andy, I'm coming up on my third year with the team in February.
Excellent. Well, we're really glad that you're here, and it's fun to collaborate you and the other members of the investment committee. For those of you that are not aware, there are 4 active members of the investment committee that convene on a weekly basis, in addition to ongoing communications throughout the week. There are a large pool of resources available to the investment committee, and they are responsible for the asset allocation, and then Michael Kolb on our team is responsible for the asset implementation across most portfolios. So today we're going to review the outlook and positioning uh, presentation. Derek, would you mind cueing that, and we're going to work through that. As he does, I just wanted to make a quick announcement about a couple things that developed within Evergreen in 2023. We're very proud that Todd Rischel, certified financial planner, joined the firm in July. He and his clients have been a welcome addition to the firm, and we've had a lot of fun working with Todd and really enjoyed collaboration and his expertise, nearly 30 years of industry experience. In addition, we added a new member to the team. Justin Warfel is a associate advisor working alongside Jesse Cornell. And Justin has passed the Series 65 Life and Health, and just starting the CFP track that Jesse is offloading. So we're very excited that we now have 2 additional associate advisors that are assisting sometimes at the meetings, but often they're very involved in planning alongside with Michael and many other projects within the firm. So if you haven't already, you'll certainly be hearing from them as we work to serve you. Derek.
Thanks, Andy. So I'm going to cover our outlook and positioning for 2024. So I'll begin with a recap of 2023, which began as a challenging year with inflation picking up and concerns about a recession in the market. We were not really overly concerned about a recession in 2022 or 2023, despite all of the market volatility, and I'll explain why as we roll through the presentation. But we started to see some relieving of financial pressures in the fourth quarter, inflation normalizing, interest rates starting to decline, and we saw markets really lift higher in the last few months of the year. So the S&P 500 index increased by about 26% during the year, but other parts of the market, such as an equally weighted stock index, small cap U.S. companies, so companies like airlines and banks and restaurants, as well as foreign stocks, emerging markets, and even bonds have recovered and had a decent year after a very rough few years in a higher interest rate environment. So as we step forward into 2024, we anticipate that the economy will remain resilient. It wouldn't be surprising to see a bit of a slowdown in household spending in the face of higher costs, higher prices. What I'm sharing on screen is the interest rate increase by the U.S. Federal Reserve during the last few years in an effort to try to control inflation. So this is the mechanism, one of the primary mechanisms that the Fed uses to try to slow down the economy whenever it's um, whenever inflation is overheating, to try to avoid a big sort of boom and bust cycle. And then if we go through an economic slowdown or recession, the Fed will lower interest rates. So this has the potential to um, slow the economy, as I said, whenever interest rates are higher. So think about when you go in to get a loan, if interest rates are very low, or a mortgage, you may be able to buy more of a home than when interest rates are very high. So that has the effect of, slowing down the housing market, slowing down home activity, slowing down borrowing. So that idea has permeated every part of the economy for the last few years. We're starting to see that the Fed has slowed down in raising interest rates, and we're starting to see that pressure abate. Part of the reason why is that inflation has come down. So we're seeing, uh, as of summer 2022, costs were rising at a 9% annualized rate. So the basket of goods that we all need to, use to live on, like energy and vehicles, food at home, shelter, restaurants, those as a group were rising at about a 9% rate in summer of 2022. And we've seen the pace start to normalize back to a 2 to 3 long-term normal rate of 2 to 3%, driven largely by lower inflation in food, as well as actual deflation in the price of automobiles in red, as well as energy in green. You can see how this affects the market graphically. In the top chart, we have the 10-year Treasury rate, or long-term interest rates, and then the bottom we have the S&P 500, or the stock market, the largest 500 U.S. companies. As interest rates were inflecting higher during the summer of 2023, we got to about 5% on the U.S. 10-year Treasury rate, which we haven't seen in quite some time. And that had the effect of slowing down the potential effect of slowing down the economy, and it was showing itself most visibly in the stock market, which had started to decline. And we saw inflation start to normalize. The U.S. Federal Reserve, started to adopt a more accommodative monetary policy, and interest rates started to decline. Stock prices started to lift again. The S&P 500 was up about 13% in the last few months of the year. But encouragingly, some of the positions that we have in client portfolios that we believe there's real value in, or long-term growth, those did exceedingly well in that environment. So small U.S. companies up 21% as an index in the last 2 months of the year, and biotech, or small innovative healthcare companies, up 32% in the last few months of the year. We've been in this environment before. So the U.S. Federal Reserve, after the financial crisis of 2008, was finally raising interest rates from zero they got to about 2.5% in late 2018. The economy was starting to show signs of slowing, and that was becoming evident in the stock market. The stocks declined about 20% into Christmas Eve of that year, and the Federal Reserve began to again adopt a more accommodative monetary policy, and just changed their tone, did not raise interest rates, telegraphed to the market that they would be accommodative, and the market started to recover by about 23% in the year that followed. We had the same Federal Reserve chair at the time. His name was Jerome Powell. His name still is Jerome Powell, and he's at the helm today. And we expected the same sort of environment, where we would see the Fed eventually declare inflation as largely in the rearview mirror, and would begin to normalize monetary policy. And that occurred in the fourth quarter of 2023.
Derek, thank you for that. And we were waiting for a while for this to happen. It's interesting, as investment advisors and members of the investment committee are looking at what are opportunities to exploit within the market, within different sectors, whether they be stocks, bonds, large, small, growth, value. But on the first slide that Derek showed, it showed that dividend stocks were pretty much flat for the year, where the tech stocks mostly led the S&P 500. Everything else is kind of in line with normal valuations. So one of the things that they're consistently looking at is where are their asset classes to be exploited? And part of that is a good reminder that the stock market and the economic cycle are not necessarily in sync. So this is a great visual, and I'm really glad that it's in this deck, that the stock market is a leading indicator from where the economy is. And as you can see, as the stock market crests, it crests before the economy does. And by the time the economy is at the very bottom, the stock market has likely already rallied. So just a very good reminder that what you hear in the news about the economy is not necessarily in sync with what's happening with the stock market, and it is a leading indicator. Thank you, Derek.
Yeah, well said. I know, Andy, you like a good quote, so we included one here for this slide. It's from economist Paul Samuelson, and he said the stock market has predicted 9 out of the last 5 recessions. So we saw that in the previous slide about 2018. We never went through a recession until the pandemic a few years later, but the market was definitely behaving as though a recession was on the horizon. And 2022 and 2023 were a similar environment where we saw the market starting to slide in anticipation of the potential for a recession. We did not anticipate one in 2022 or 2023, partially because of just how robust the labor market has been and has remained in the face of higher interest rates. Now everyone has their theories as to why that is, whether it be, folks leaving the labor force, early retirements during the pandemic. My personal theory is that remote work reduced a lot of the frictions around changing jobs. But for whatever reason, the labor market has remained very robust. 3.7% unemployment is near a 50-year low, and having unemployment remain this low in the face of such a massive interest rate hiking cycle is almost unprecedented. So we have 8.7 million job openings in the United States. So the way you would interpret that is that employers still feel very confident in hiring, and they feel very confident in their future revenue. One area that is, that is noteworthy is that households had a good bit of savings pickup during the pandemic. Everyone got their stimulus checks and they refinanced their mortgages at lower rates, and so personal savings, the rate increased pretty significantly, and the excess savings, so in the shaded blue area, started to really build up. Now we're seeing that start to decline. We're seeing credit card debt go up a little bit, so that's something that we're watching. It wouldn't be surprising to see a slowdown in household spending in 2024 as we all look at our credit card statements after the holidays and say, oof, I better, slow down a bit in the first half of the year. So as we go into 2024, we titled our Outlook piece, the written version, which accompanies the slides, as finally normal. So what that means essentially is, even though the pandemic is largely in the rearview mirror from a health perspective, the implications of that have been reverberating through financial markets for a few years. So just to take you back as a reminder, the pandemic occurred in 2020. Governments responded globally with massive stimulus, lower interest rates. We also saw a shift toward e-commerce at the time, and work from home became part of the normal lexicon. In 2021, we got our vaccines, and the U.S. started to go toward a more normal social interaction. And so we still had lower interest rates, unprecedented stimulus, and the economy went through a big booming reopening, and we saw that in the stock market as well. And then in 2022, the inflationary effects started to pick up there. So Russia invaded the Ukraine early that year, which took a lot of energy and commodity energy and commodity off the global supply chain, caused prices to go up. Prices were already going up because of supply chain issues in Asia, higher stimulus, lower interest rates. And the stock market started to decline in the face of the U.S. Federal Reserve beginning to try to fight inflation and raise interest rates. In 2023, the economy remained resilient, and we started to see, as we mentioned before, kind of that pickup in stock prices. So we go into 2024 in a finally quote unquote normal environment because inflation has normalized, stock prices have largely normalized, and interest rates have largely normalized. And so, Andy, you and I were talking offline. In our careers, we've been in a very low interest rate environment actually since 2008. So,
Yeah, I'd love to comment on that.
yeah, please.
As we were discussing before recording this, I know many clients that were able to refinance into 15-year mortgages. I think the winner was 1.99% was the lowest that I personally saw, but many clients had refinanced their homes at 2.25% or somewhere in the low twos. And as of a couple months ago, we saw the 30-year hit in the mid sevens. So if we think about that a little bit, over the last we're talking about a normal period that we're approaching now after 4 years of abnormality. But through our discussion, we pointed out that this all started quite a while ago, back in 2008, when we had the Great Recession. So if we kind of think through the ramifications of what does that mean, most of us have a collective experience of low interest rates for about 15 years, which feels very normal to us because it was such an extended period of time. But in fact, if you pull back the lens over a longer period of time, it's quite abnormal. So if we go back to all the textbooks and data, it shows that over the last 60 years, the stock market has averaged 10%, the bond market has averaged 5.33, and money in the bank has averaged 3. Our experience over the last 15 years has been somewhat accurate on the stock side, but as it pertains to money in the bank and bonds, we were not seeing anything near those long-term averages. So if we look back at what are some long-term mortgage rates between 1971 and 1923, the average 30-year mortgage rate was 7.74%. That was average. That was normal. The all-time high was hit in October of 1981. 18.63%. And that low was pretty recent. January of 2021, the 30-year hit 2.65. So I just wanted to make a point for everybody that's watching this, that what has felt normal over the last 15 years is really anything but. And we now believe that we're moving back to a period of normal. And we will be recording a separate podcast that is going to expound more on the details of that white paper, and it is available it'll be available on the white paper section of our webpage as well.
Well said. Thanks, Andy. So as we look for potential catalysts and drivers and risks in 2024, to us, it really we see three primary drivers, three primary risks. I'm sure we're going to eventually miss something. There'll be something surprising. There always are in markets, but our drivers are resiliency. The economy's been, as we said, very, very resilient in the face of inflation, higher interest rates, et cetera. We think that can continue, albeit at maybe a slower pace than last year. Price, which we'll touch on in a bit. Companies in general across the market are attractively priced or fairly priced, which is, we haven't seen that environment over the last few years has been sort of mixed in terms of how securities are priced. And then productivity we'll dive into in greater detail in the white paper and the podcast discussion that Andy just mentioned. But we're seeing a lot of pickup in artificial intelligence and productivity gains that we think can drive corporate earnings and just in general drive higher quality of life and standards of living over the next decade plus. And I think that'll start to be reflected across stock prices. Primary risks for next year, for this year, inflation. We do think the economy is stronger than a lot of maybe economists and other market forecasters feel. So it wouldn't be surprising if you see, as interest rates come down, the economy remains resilient. It wouldn't be surprising if you see a pickup in activity that causes inflation to be more prevalent than a lot of folks anticipate. The election has the potential to be a source of volatility. Election years are volatile in general. And then geopolitical conflict, this is something that we're all aware of, that there are two very serious wars in Eastern Europe and the Middle East, with the potential for a third between China and Taiwan. These have largely, outside of causing some inflationary pressures from the Russia-Ukraine war, these have largely not impacted financial markets, but they have the potential to. So from a market perspective, one of the things that Andy and we talk about a lot is just the last 2 years, how challenging that has been for us and for investors. So markets have gone largely sideways for about 2 years, but we look under the hood. We talk to companies. We participate on earnings calls, and we see that companies are executing well and they're growing revenue and they're growing earnings, but their stock prices have largely traded sideways for 2 years. So we think that this will be the year that the S&P 500 hits a new all-time high, and we see those gains continue. In the market, we are seeing large U.S. companies like Apple, Microsoft, Amazon, Alphabet. They're taking increasing share of the S&P 500. So we're looking to other areas of the market for value, which we'll show you in a moment. But just as students of history, we note that those companies at the top don't tend to stay there forever. So in the 1980s, in the 90s, you saw companies like old tech, telecom, oil, even tobacco, believe it or not, was one of the largest companies in the S&P 500 in 1990. But you note that these are not in the top holdings anymore. So it wouldn't be surprising if we look in 5-10 years and we see a new top holding. So that's what we're always on the lookout for, is who's going to be the next big performer. From a valuation perspective, as I mentioned, when we look across the market, we see the largest U.S. companies, the S&P 500, a little bit above its long-term average from a price perspective. And that's really driven by those large growth stocks. The Apples, Amazons, Microsofts of the world are really driving that valuation in the index higher. So from a price perspective, what you're paying for those earnings, what you're paying for those companies. But when we look across other parts of the market, they look much cheaper than the largest companies, number one, but they also look like they're trading close to their long-term averages or better. So just the average stock in the S&P 500 trading close to its long-term average, much cheaper than large tech. Dividend stocks, which we've talked about a lot, trading at the lowest, close to the lowest they have in the last 10 years. So we think there's opportunity there. Small caps, again, this is things like airlines and restaurants, trading close to their long-term average, and then foreign stocks and emerging market stocks. So when we use that premise of finally normal for 2024, this is part of it, that, other than a handful of the largest companies, we see opportunity abound across many different parts of the market. So to sum up on the economy side, the economy is in good shape, not the strongest it's been historically, but we don't see us going into a recession in the near future, because of employment is solid and financial conditions are starting to normalize. We have the U.S. government spending on infrastructure in the form of the CHIPS Act, trying to bring computer chip manufacturing back to the United States, and the Inflation Reduction Act, just trying to bring manufacturing in general back to the United States. And then on the market side, from a valuation perspective, stocks look attractively priced. Earnings have been relatively stable and growing. And on one point of caution is that investors have turned relatively bullish fairly quickly. So we like the Warren Buffett quote, "Be greedy when others are fearful, and fearful when others are greedy." We have seen a little bit more enthusiasm, I'll say. I don't want to say greed, I'll say enthusiasm around the stock market in the last few months of 2023. And so we think that we might see a little bit of of volatility as that enthusiasm wanes in early 2024. So Andy, I'll turn it back to you if you want to go through the election, or I can cover productivity.
How about you slide into productivity? But before you do, I want to point out that as we're entering into 2024, this recording is made on the 11th of January, so you'll probably see it by the mid second or early third week of January. Um, After a very frustrating nearly 2 year period, we saw areas of the market that we found opportunity roar back in the last 2 months of the year. And we think that there are many reasons to be optimistic over the intermediate and long term. But we are heading into election season, and we're starting the year with some lofty valuations within some areas of the market. While our client portfolios, we believe, are well positioned, we do expect that we will have some volatility. So I think talking about the long-term opportunities with productivity would be appropriate. Thank you,
Okay.
Derek.
Yeah, happy to. So one of the things that we've really started to pay a good bit of attention to has been artificial intelligence and productivity. So this is an area that has been discussed in the investment industry for probably at least 10 to 15 years, but we're starting to finally see, with the advent of general artificial intelligence and tools like ChatGPT and others, the tools, I would say, have finally caught up with the hype, if that's a good way to put it, that they are actually leading to real productivity gains for companies. And so we think that we're in the early stages of potentially another technological revolution, where we see this technology start to permeate all parts of the economy and increase the quality of our lives. So just as one quick example, if you know those AI kind of chat bots that are out there, like Andy, if you go on your bank's website and you say, "Hey, I need help with something," and then it's a chat tool, and it's not that helpful, right?
Or
Well,
what I call my cable provider or insurance company. Yes, I know
yeah.
exactly what you mean.
Yes. Well, so you can see here we were measuring the complaint resolutions per hour, and your experience is not uncommon. They're essentially zero, no complaint resolutions. Uh, then the advent of actual generative artificial intelligence tools that can actually understand questions, answer questions, pull from data, are actually resolving problems now. And so you think about the implications of that leading to just increased productivity, increased lower costs for companies, that they can have these types of tools solve more problems. So we're seeing, this is just one example. When we look across, companies like Walmart increasingly investing in artificial intelligence for managing supply chains, or tools like robotics to manage inventories. Companies like Deere are investing in autonomous tractors and drone technology to fertilize fields. We're seeing it sort of start to permeate everywhere, and we think that over the next decade or so, this is going to be a central theme to driving not only revenue, but also driving down costs for companies, which increases earnings. So we're optimistic about this as another kind of technological revolution, which we expand on in our white paper, and we will expand on in our podcast discussion. So on the election side, I'll cover this briefly. We do believe that election years have the potential to be quite volatile, but in general, when we look at the average, the market tends to do well in the long run, on average in election years, but the range of outcomes has been very, very wide and much larger than other years of a presidential term. So that's something we're very mindful of going into this year, is just the potential for market volatility. When we look historically, we don't see any real key trends across, whether it's one party in power or one sort of mix of power across the White House and Congress. markets tend to do well in general. Markets tend to perform well no matter kind of who's in power in Washington. We did see, in the scenario where we have a Republican president and a divided Congress, that one's a little bit lower, but we think it's biased down by the experience of President Bush during the financial crisis, and then also from September 11th and the tech bubble burst. So we think this data point may be a little bit unfairly biased lower by those events that were probably largely out of his control. In terms of who will win the election, one interesting note is that markets tend to actually predict this quite well. So over the last 24 elections, if the market was up 3 months before election day, the incumbent won, and if the market was down 3 months before election day, the incumbent lost. So whether we believe it or not, we all tend to vote with how we're feeling with our wallets and what's happening in our portfolios. So the market actually has been quite a good forecasting tool.
I know historically that has been the case. It is interesting, and I don't want to make light of this election cycle. For many of my client conversations and conversations with family members and friends, I get the sense that there's a tremendous amount of division within our country right now, particularly politically. And I've heard many people say, well, this is the most divisive period we've had in history. And just to bring a little bit of light to that comment, which I've heard so frequently over the last year, and more so over the last several months as we're gearing up for hearing both Biden and Trump again at the time of this recording, we have had some more divisive periods of time in our history. If we rewind to as recently as the decade I was born in the 70s, the amount of division in our country was far more pronounced than we have today in many aspects. And if we rewind the lens a little bit further, there was a period of time in which we had civil war. While I hear so many things, I do want to remind folks that in the long run, that elections don't seem to carry as much of a weight as they do to many of us personally. So I wanted to start with a quote from Brad McMillan, who's the Chief Investment Officer of Commonwealth Financial Network, our partner when it comes to our backbone from technology. Starting with the bigger picture, over time, elections don't matter. If you zoom out on market performance or economic performance for that matter, and cover up the dates, you can't tell which party was in the White House or controlled Congress. The US economy over time just keeps on growing. The basic reason for this is simply that Washington, D.C. can set the overall rules, but at the state and company level, the American entrepreneurship simply figures out how to either take advantage of or, in some cases, evade and minimize those rules. Most of the country works despite, not because of the federal government. Thank goodness for that. So as we talk about something as polarizing as the elections in 2024, I just wanted to pull back the lens a little bit, as it's so easy to get caught up in the nightly news and what we're going through in the short run.
That's well said, Andy. So just to sum up for everybody, we anticipate that 2024 will be one of the first quote unquote normal environments from a market perspective that we've had in maybe at least 4 years, as you said, maybe 15 years. So we're excited about it. It's easier to produce a mid single digit return with relatively low risk, and for clients that have more stock market exposure, we think many parts of the market are attractively priced. We think interest rates are normalizing, inflation's normalizing. We do have the potential for volatility because of, as you just said, the election year, as well as some of the geopolitical risks with the conflict in Europe and the Middle East. So that's the market outlook. We're excited for the environment. We think it's going to be a positive year, but anything can happen, as we know.
We appreciate the opportunity to serve you and do our best as a firm to gather resources for you to have ongoing contact with our thinking as a firm. So while we will meet with you depending upon the sequence of reviews that are appropriate in your situation. We'll meet 1 to several times a year. Know that we're constantly working on your behalf, and then also publishing content. The goal of this webinar is to be able to give you give you some insight into our thinking in the year ahead. And as I mentioned, there is a section on the webpage that will contain the white paper. We do push podcasts and quarterly recordings. Of course, if there's anything that we can be doing to serve you along the way, please contact Todd, Jim, Ed, myself, or any member of the team. We are here to serve you, and we appreciate the opportunity to do so. We wish you a great 2024 and are looking forward to more opportunities to connect and grow together in the future. With that, thank you so much for your time today, and please keep us in mind in the year ahead.